Hi everyone, welcome to True Corporate Business Solutions. We give you solutions. Right, today we want to look at International Financial Reporting Standard number 5, Yield for Sale, which is meant for those who are doing SBR, that is Strategic Business Reporting, and those who are doing Financial Reporting F7. So we have Yield for Sale. Yes, a non-current asset can be classified as yield for sale. But what you have to understand is, normally when a company has the non-current assets, normally they will be using those assets with the intention to use them, not to sell them or what. Right. So when a non-current asset is held for use, it is classified under IAS 16 PPE. Right. So when they have the intention to use it. But now when a non-current asset is now classified as held for sale, it now means that they no longer want to use it. They no longer have the intention to use the asset even in the long run. So when they have the intention to sell it, we now need to know how we are going to treat in the books, the accounting treatment. So what you have to understand is there's a difference between the non-current assets and the current assets. The non-current assets, they are held for use, and when we say under non-current assets, we expect that they will last for a long period of time in use. But now on the current assets, these are the assets, short-term assets that are held for trading purposes. Right. So when a non-current asset now is now classified as held for sale, do you agree with me that we now have to reclassify it? So it has to be removed from non-current assets and recorded to current assets. Because current assets, these are the assets that are held for sale. So when a non-current asset is held for sale, then it's now a non-current asset, it's now a current asset. Because we now have the intention to trade it. So it has to be reclassified from IAS 16 PPE to what? To IFRS number 5, held for sale. So just know that a non-current asset is classified as held for sale if its carrying amount is recovered principally through a sale transaction rather than through continuing use. So we now no longer consider the benefit that we get if we continue to use the asset. But in terms of valuing it, we have to consider that how much do you expect to get if we sell the asset. Right. On held for sale. So are you seeing that when a non-current asset is now held for sale, it will be classified as a current asset? Do you agree with me that all current assets are not depreciated? So from the date that you classify a non-current as held for sale, from that date you do not depreciate. You do not depreciate the asset from that day. Alright? But this is what you have to understand as an accountant. So don't just believe the information it says, but don't just believe even when people say our asset is classified as held for sale. What if there are people who want to manipulate? What can you see this? Can you picture this? That they're saying it's held for sale, and from that date they won't depreciate. So that means if they don't depreciate, we will not have the depreciation expense in the profit or loss, and the profits will be high. What if people are manipulating? What if they are not telling the truth? What if they are lying that this is held for sale so that they won't have the depreciation amount, so that they overstate profits? So as an accountant, when you are told that a non-current asset is held for sale, don't just believe that they have the intention to sell it. You have to assess, you have to check whether it has met a certain criteria. Is it really classified as held for sale, or they just want to manipulate the books? You understand? So there are conditions that must be met for an asset to be classified as held for sale. Number one, the asset must be available for immediate sale in its present condition. So who will say that? Is that asset available for sale in its present condition? So if, let's say, I can give an example of a motor vehicle. Okay, you are telling me that your car is held for sale. That's fine. Okay, what if someone is willing to buy? Are they willing to do the transaction? If you hear them saying that we want to repair the motor vehicle first, that means the books are not showing trade fair value. Why Yes, because you guys, you have said it's held for sale, but someone wants to buy it, but you are now saying that we want to repay it first. Then if you want to repay it first, then why have you classified it now under current asset? You were supposed to just wait, then repay it, then after you classify it as held for sale. So if you classify it as held for sale, that means it must be available for immediate sale in its present condition. Number two, the sale must be highly probable. So you have to check that, is the sale highly probable? Is it likely that that asset will be sold? If it is likely, then you say, yes, it can be classified as a held for sale. But how do you know that the sale is highly probable? How do you know that? Yes, so we will say that even the management must be committed to a plan to sell the asset. I'm talking about the conditions that must be met for an asset to be classified as held for sale. The management must be committed to a plan to sell the asset. They will be very sure that yes, they really want to sell that asset. Another thing, they must charge a price which is reasonable. Yes, for example, I give an example that let's say we have a laptop, and a new laptop costs, let's say about 600 US for argument's sake. Let's say the new one costs $600 US, right? Then you have used that laptop over a year, but that same laptop, it costs $600 US if you want to buy a new one. But the one that you have used for more than a year, you are now selling it at 600. Does it make sense? The new one costs 600, but the one which you have used over a year, you are selling it at 600. Doesn't make sense because it has depreciated, it has lost value. So if you charge that price, we will say that it's not reasonable. It's clear, it's now clear to us that you don't want to sell it. You understand? So if they are not charging a price which is reasonable, it will be questionable. And another thing, there must be an active program to locate the buyer. So we ask them that, what are you doing? What are you doing? What will cause the asset to be sold? So if they are doing maybe even advertising what, then we'll be saying, yes, they really want to sell the asset. You understand? So those are the conditions that you must know for us to say the asset is classified as held for sale. Right. Now, when a non-current asset is held for sale, when we measure it at the law of carrying amount and the fair value less cost of disposal. Carrying amount, that's the one we used to call net book value, where you say cost less the accumulated depreciation. You understand? So the amount that is remaining, the carrying amount that is in the books, versus the net selling price. That's what we are saying. Net selling price. We're saying selling price less all the cost of disposal, selling cost. So say we compare the carrying amount versus the net selling price. So net selling price, we are saying what is the value of the asset if we want to sell the asset? How much do we expect to get? That's the net selling price. So we will compare the two. But remember the prudence concept. We must not overstate profits, right? We must not understate expenses. We must not overstate revenues, right? So guys, this is what you have to understand. Let's say the carrying amount in the books, using my example, let's say we have a carrying amount of 500. Let's say we have a carrying amount of 500. Then this is the carrying amount of the asset that we are now saying is classified as held for sale. That's the carrying amount. Then we will ask ourselves a question that if we want to sell this asset that is a value of 500 in the books, how much are people willing to pay outside? What is the fair value less cost of disposal? Maybe we will say that the fair value is 450 less the cost of disposal of 50, meaning that if we sell it, we will have 400 US in our hands. So that means the books are saying it's 500, but if we sell it outside, we will actually get 400. Are you seeing that we will be saying you have overstated the amount? So what do? So this will be now clear that an asset is overstated. So it has to be impaired. So we will then apply International Accounting Standard number 36, which is impairment of assets. So 500 that is in the books versus the 400 that you can actually get. So you impair the asset by 100,000. So there will be an impairment loss of 100,000. We'll be saying the asset is lost value. In the books it's 500, but actually what is on the ground is 400. So that means we will be saying let's value correctly. Let's not overstate assets. Let's not overstate our financial position. Therefore, recognize an impairment loss of 100,000 so that the asset will be worth 400 in the books. And the impairment loss of 100,000 of that 100 will be recognized to the statement of profit or loss. That's how you do it. That's how you do it when the carrying amount is greater than the fair value cost of disposal. But when the carrying amount is lower, then there is no, we say the asset is not overstated, so we won't impair in that case. So guys, that's IFRS number 5, held for sale.